Everyone, Davis Oliver here with the Tax to Save team. Excited to dive into a great case study we achieved for a client last year and what the outcome was for them and overall tax savings and some things we planned around for them. So, without further ado, I'll go ahead and hop right in and share my screen and cover what we're going to cover today regarding tax savings, tax strategy, and what the overall tax savings ROI was year one for this client. So, with that said, I'll quickly share my screen. And so for those that are watching, right, we got the tax return on the left and the scenario of what's happening here on the right. And let's get my screen share all situated here. All right. So with that being said, right, we got this client, 64 years old, out of the state of Colorado, married, filing jointly. He's now a retired dentist that we helped out here. And so he had a little bit of W-2 income before he officially retired last year, as you see on line 1Z. But the big thing what this client did, all of this income added up, was 724,000. But I'll draw your attention here to line 4B, where he did a $518,000 Roth conversion. And we're really helping to mitigate his required minimum distribution taxes and getting out ahead of those, as well as planning around IRMAA if the strategy he chose. So with that income, he would have paid on 724,000 in the state of Colorado, married filing jointly, $214,000 federal and state tax. What he decided to do was he implemented a strategy under Section 179 and now with the big beautiful bill, 100% bonus depreciation under Section 168K, where we helped him create a very simplistic business. In that business, he outlaid some capital. His outlay for to start that business with some seller financing leverage was $107,000 that generated a $535,000 deduction year one that he got to use. So you'll see here, right here on line 8, I'll draw your attention. That was the deduction that was taken for him. And you can see here, line 8's a perfect line, especially when we're starting to plan around IRMAA, income-related Medicare adjustments. For those that are 64 and older, you know what I'm talking about. And if you don't, we'll teach you more about it here at Taxes Saved and why it's important to consider the government gotcha. So with that, right, we took his income after the deduction and strategy put in play. That again cost him 107,000, but it saved him. It brought down his new taxable liability on line 11 to $188,000. With that, his new tax bill is literally less than 24 grand state and federal. So in 1 year, $107,000 outlay of a deduction that generated 535,000 in losses saved him in first year taxes $190,000. Year one, folks, just the return on tax was 178% return on tax alone. We're not counting about other business income and things that's generated with the software business he has now. But the great benefit year one, just the return on tax, the capital outlay was less than what his capital return of tax savings were of 190 grand. If this is of interest to you, there's still time to save tax here in 2025. We are running out of time. We have to implement and educate you before education first and then implementation following before 2025 ends. So if you're looking to do Roth conversion to offset the taxes, there's still time to implement strategy to do so. Or if you're a high income earner or a business owner with good income, please just reach out so we can get you educated, see if we can best serve you this year, or maybe another year is better. But just please reach out to taxessave.com. That's taxessave.com to check in on these case studies and others we have helped clients with over the years. You can tune in there to check that out. And we look forward to speaking with you in your situation soon. Thank you.